Thanks for clicking. The Bank of Canada is seriously looking into increasing the pace and severity of interest rate hikes. This was the message taken by Deputy Bank of Canada Governor Sharon Kozicki after a speech given on Friday. Prior to the speech, traders, for the most part, were betting on 9 interest rate hikes over the next year, and those traders doubled down on those bets following the speech by Kozicki. And for good reason. Much of the speech seemed intent on preparing Canadians for increased interest rates in the future, while simultaneously assuring them that the Bank of Canada was confident they could handle those interest rate hikes.
Some of you may die.
You get the idea. So what I want to do today is go over why the Bank of Canada thinks Canadians are more than apt to handle these interest rate hikes, some problems the bank see coming down the pipe in the future, and why some analysts are thinking that we might be seeing a 50 basis point rate hike in April. We'll all know soon enough, as the Bank of Canada is set to make its interest rate announcement in a little over 2 weeks, and obviously we'll have that update here on this channel. If you want to get those updates, make sure you click like and subscribe, but for now, let's get into the speech. Bank of Canada Governor Sharon Kozicki definitely tried to strike a reassuring tone as she tried to prepare Canadians for what's to come in the future. First, the Deputy Governor noted that while interest rate hikes are coming, they will mostly have an immediate impact on home buyers, and that existing homeowners won't be impacted for some time.
One is that while rising interest rates will have an immediate impact on new home buyers, they'll have a more gradual impact across existing homeowners.
With over 3/4 of Canadian mortgage holders having fixed rate mortgages and the majority of the home buying at these elevated prices being done in the past 2 years, for the next couple of years at least, existing homeowners shouldn't have to worry about renewing their interest rate. Further, if you did buy in the past few years, so long as you were at a fixed rate mortgage, and with most Canadians going with a 5-year fixed mortgage, they won't have to worry about these interest rate hikes until 2026, 2027. So, for the people that bought prior to the pandemic, over the next few years, they should have an interest rate that's relatively the same.
And people renewing over the next couple of years will likely get rates that are similar to what they're paying now.
Whereas, according to Kozicki, if you bought in the past 2 years, you won't be looking at these higher interest rates until 2026, 2027, leaving Canadians with ample time to prepare for these higher interest rates.
You have plenty of time.
Second, Kozicki noted that during the past few years, throughout the pandemic, Canadians took advantage of these lower interest rates and took advantage of the prepayment privileges offered to them by their mortgage lenders.
A lot of households paid down principal during the pandemic. When rates fell, households on variable rate mortgages with fixed payments paid down extra principal. Meanwhile, some with fixed rate mortgages prepaid by setting higher regular payments or through lump sums.
As a result of these prepayments, Kozicki said that households are more than apt to handle changes in interest rates that are coming down the pipe.
As a result, many households have more financial flexibility now.
So I guess the reassured message being delivered by Kozicki is that if you prepaid on your mortgage, you're better apt to handle the interest rates. If you don't have a mortgage renewal coming for a few years, you'll also be able to handle the interest rates. And if you do have a mortgage renewal coming or you didn't prepay,
that puts you out of luck.
Indeed, the Deputy Governor said that there are some concerns going forward, which the Bank of Canada is well aware of. First, and we've talked about this on this channel, while Canadians did reduce their debt loads during the pandemic, much of the consumer debt is going back to pre-pandemic levels.
While household indebtedness initially improved earlier in the pandemic, it has since risen above pre-pandemic levels, and its elevated level remains an important domestic vulnerability.
And yeah, we've talked about this on this channel. With consumer debt levels returning to their pre-pandemic highs, with consumer debt levels really going through the roof over the past couple of years, these interest rate hikes are definitely something to be concerned about going forward. And it does look like the Bank of Canada, although they're going to raise interest rates anyway, are aware of these increased debt levels and what interest rate hikes could do to the debt servicing ability of Canadians going forward.
It's that I just don't care.
Don't.
Second, and this is a big one, the Bank of Canada is well aware of the extra large mortgages being taken out by home buyers, especially relative to their income.
The rapid rise in house prices during the pandemic has led to an increasing share of households taking out new mortgages that are large relative to income. And a growing share of these mortgages have variable rates.
So large mortgages being taken out over the past few years, especially relative to income, make home buyers, make current homeowners, especially those with variable rates, more susceptible, more vulnerable to the rising interest rates that are obviously coming down the pipe sooner rather than later. And finally, on this note, the Deputy Governor noted that while Canadians did increase their savings rates throughout the pandemic, which should act as a cushion for these higher interest rates, it's highly doubtful that those who took out these large mortgages, especially large mortgages relative to income, it's highly doubtful that those are the ones with large savings accounts, which will make them even more vulnerable to these interest rate hikes.
The households that have taken out mortgages with high loan-to-income ratios probably aren't the ones who still have a lot of cash in their bank accounts.
So high consumer debt levels, high mortgages relative to income, and minimal savings will make sure that these interest rates are relatively more difficult for a certain portion of the Canadian population.
No shit.
With all that said, Deputy Governor Kozicki is confident that Canadians can handle the increase in interest rates.
Adding it all up, though, we see that households on average appear to be in better financial shape now than at the start of our 2017 to 2018 tightening cycle.
Yeah, if you'll remember, in 2018, Bank of Canada raised interest rates to 1.75 or 1.25 higher than they are now. So the Bank of Canada is going to be raising interest rates, that much is clear, and they're going to be raising them higher than usual. That much is clear as well. But what's making analysts think that we could be looking at a 50 basis rate hike, a large rate hike come the April announcement, is Kozicki's use of the word forcefully.
It's important to be clear. Returning inflation to the 2% target is our primary focus and our unwavering commitment. We have taken action and will continue to do so to return inflation to target, and we're prepared to act forcefully.
Yeah, after watching the speech, BMO analyst Benjamin Reitz said that this was a clear nod for a 50 base rate hike come April. For their part, traders also seem to agree with the sentiment that we could be seeing a 50 basis point rate hike come April as 10-year yields rose following the speech, and we also saw a strengthening of the Canadian dollar. So yeah, the speech definitely came off as preparing Canadians for higher interest rates soon into the future. The speech did offer some reassurances, although not very comforting ones, that Canadians are well prepared for these interest rate hikes coming down the pipe. But it definitely came off as saying that Bank of Canada is going to act, and it's going to act forcefully. As the past few months have shown, inflation is not going away anytime soon. While we spent the last couple of years, 2020 and the beginning of 2021, with the Bank of Canada talking about transitory inflation and that the inflation wasn't going to be permanent, it doesn't look like that's the case. Throughout that time, the Bank of Canada was hesitant to raise interest rates for fear that it would hurt our employment, that it could hurt the overall economy. And I think this speech shows a real shift on the part of the Bank of Canada in that they are going to tackle inflation and that they do think that the economy can withstand it. With our unemployment at pre-pandemic levels and with a tight labor market, the Bank of Canada is confident that A, Canadians can handle the rate hikes, and B, that these rate hikes are needed to tackle the inflation rate. If we agree that they need to tackle the inflation rate, that our inflation rate is unsustainable, and if we don't get a hold of it soon, it could definitely go much higher in the long run, then these interest rate hikes are needed in order to tamp down that inflation. As we talked about a few weeks ago, when interest rates are below the rate of inflation, which has only happened twice over the past 50 years, but when interest rates are below our inflation rate, we're effectively looking at negative interest rates, and negative interest rates is not how you slow down an inflation rate. Negative interest rates push people to spend. They incentivize people to spend. They incentivize the upward pressure of prices, as it's not worth it to Canadians to hold on to their money, as it won't be worth as much in a year from now. So, if the Bank of Canada is serious about getting inflation under control, if Canadians are serious about getting inflation under control, if that's going to be our number one priority, then we are going to look for higher interest rates well into the future. And from judging from this speech, it is looking like the Bank of Canada is going to act forcefully in its April interest rate announcement. We'll obviously have updates on that interest rate announcement and the lead up thereof on this channel. If you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.